So we'll start with a statement of operations comparing 2016 to 2015 with sales this year of $632 million versus $582 million a year ago, up about $50 million from one year to the next. Our gross margins slightly over $100 million this year versus slightly over $90 million last year, up $10 million from 2015. Then we get into the operating expenses. The first area that we're going to talk about is the merchandising expenses. Salaries and wages is the big one there. $35 million this year versus $31 million last year. And then we have less wage reimbursements. Our less wage reimbursement is the credit we get for the contract people that we have working at the ethanol plants that are under our administrative services agreements. So you net that back out, and our salaries and wages are $29,125,000 versus $25,186,000 last year, up about $3.9 million. With the addition of the ADM for the full year and Ag Ventures and Grain Ventures for the full year, we feel pretty confident that that number is a realistic number. Next is payroll taxes, similar to both years. $2.2 million this year versus $2.1 a year ago. Employee insurance, I think everybody knows what's going on with insurance. Continues to go up. About $4.3 million this year versus $3.5 last year. So up slightly, but obviously we have more employees this year with those acquisitions for a full year. Pension expense, $787,000 versus $707,000. We'll move into vehicle expenses. We have about $5.7 million compared to about $5.3. There again, more vehicles on the road, moving more products. So realistic increase is expected. Supplies and licenses, 1.2 versus about 1.1. They're again very similar where we were in 2015. Utilities, about 2.4 million versus about 2.2. So you can see it's up slightly, and there again additional facilities that we're operating. Repair and maintenance, 1.7 versus about 1.9. So you can see our repair and maintenance is down slightly. Some of that has to do with the improvement that we've been making in our fleets over the years. We're starting to see some positive results there in reduction of costs. Advertising, $207,000 versus $183,000, very similar to where we were a year ago. Merchandising fees, $123,000 versus $124,000. These are fees we pay to Ponderosa for merchandising and being able to use the Ponderosa name at our two restaurants. That's all tied to a percent of sales. Corn dryer expense, you can see, is $1,150,000 versus about $1,089,000. We talked about the harvest early on. That was a lot bigger this year and a little wetter than normal years, so you can see that drying expense is up slightly, even though price of natural gas was lower. Bean roasting expense, $28,000 versus $30,000, very comparable to where we were a year ago. Employee training and travel, you can see $67,000 versus about $103,000, down slightly from a year before because not as much training and travel going on with the acquisitions happening the prior year with costs that drove that cost up. Fieldmen expense, $211,000 versus $284,000. These are contracted fieldmen. There again, several of these were converted to cooperative local hires, so that reduced the costs there. And we have miscellaneous, $56,000 credit versus a $24,000 credit. This is just expenses that come back at the end of the year where they're actually billed out and it shows as a credit. Total merchandising expense then is $49 million. 7.75% of sales versus $43.7 million or 7.52% of sales, up about $5.3 million from the prior year, which $3.9 million of that is salaries and wages. Then we get into our general expenses. These are ones that are a little difficult to control. Depreciation, amortization. As we're spending money building and buying, you can see what happens there. $21,370,000 in depreciation amortization. A year ago we had $16,065,000. So this is a non-cash expense, but it still comes out as an expense. So you can see that's over $5.3 million up from a year ago. Insurance, as we get more properties, you can see what happens there. Even in a soft market, we're still at a slight increase because of the additional acquisitions. $2.3 million versus about $1.9 million. Property taxes, the same thing, $2,067,000 versus $1,726,000. More properties, more taxes to pay. Education, rent, and miscellaneous, $312,000 versus $266,000. So our total general expenses then, you can see, are $26,052,000, 4.12% versus $19,920,000, 3.42%, up $6.1 million approximately. Interest and income and others, and here's where brackets are good. Brackets mean income. So you can see we've got a number of brackets there. We had a gain on sale of property and removal of property and equipment. This is stuff that we don't need to use any longer, and we're selling it at a profit. $286,000 versus $468,000 a year ago. Finance charge on accounts receivable, $562,000 versus $447,000. Purchase discounts, these are discounts we get for paying our vendors net 10 days, $669,000 versus $760,000 a year ago. Other revenue, $1,597,000 versus $1,754,000. This goes all the way from rental revenues for cell towers to a number of different things that we have rented that we get paid for. Interest expense, you can see last year we had a little bit more borrowed money, $892,000 of interest expense versus $642,000 the year before. Provision for doubtful accounts, we don't have anything in there. We actually had a slight gain on our doubtful accounts. I think it was a positive, close to $100,000. Collection and other expenses, $1,222,000 versus $1,503,000. So we got total interest and other expenses, a positive $1,001,000 versus a positive $1,284,000 the year before. Net operating expenses then come at $75 million, 11.91, versus $63 million, 548, or 10.92. So about 1% more than the year before, or about $11.8 million more. Local net margins, and you can see these are margins generated from the cooperative itself. $25,358,000 versus $27,171,000, 4.01% versus 4.67%, or a reduction of about $1.8 million from where we were a year before on local net margin. Income from affiliates. This is income coming in from our investments in ethanol. We have an investment, like I said earlier, in Milton, Wisconsin, and then Michigan, and then also our investment in Big River down in Dyersville, Iowa. They did very well this last year, all three of them. Contributed $14,150,000 of profits to our bottom line. A year ago was $11,329,000. So 2.24% this year of our income came from our investments in ethanol. Patronage refunds received. These are refunds received from Land O'Lakes, CHS, and CoBank primarily, and United Suppliers. $6,045,000 versus $7,041,000. As you can see, that's down just about $1 million from where it was a year ago. So you add all those up, net margin before income tax, $45,553,000. Last year we had $45,442,000. Pretty close. 7.20 versus 7.82, but dollar-wise it's pretty close. Income tax is down just slightly. $4,150,000 is the estimated income tax. Last year we had $4.2 million estimated. So our net margin that we're reporting tonight is $41,403,949 versus $41,342,120 a year ago. So about $65,000 more than a year ago. So a very, very solid year. I think everybody knows what's going on with agriculture. There's a lot of volatility, and we're very fortunate with our diversification and investments that we've made in the past to be able to continue to crank out decent returns. I think if you look at some of the returns from our sister cooperatives, they're not quite as good as this one. So.